Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields a little lower ahead of a U.S. holiday. We saw yields trade down to as low as 283, so we're getting near that 280 threshold. That really isn't the key technical level. 275 would be, it's the midpoint of the year. It's kind of that level. I think that if we start to see yields drop below 275, it really changes the outlook and you'll start to see position shifts. All those shorts in the leveraged fund community will look to throw in the towel. Likewise, I think that it would really send a signal to the Fed that whatever they're talking about, whatever they're expecting, the bond market sees something very different. So right now we continue to see yields trend lower despite the positive economic data and despite what the Fed wants to do later on this year. And if you look at market volatility, the fact that we're trending lower yields, even though it's in the face of what we're hearing and what we're seeing, it is a trend. And as we continue to hold that trend, volatility will go lower. And it was lower today. Lower ahead of a holiday, lower ahead of some key data. We got FOMC minutes, we got non-farm payroll coming up later this week after the holiday. So kind of a confusing look, despite the fact that we're seeing the market trade inside of that trend. We do have some, could be what if moments coming up on Thursday and Friday. The market does not seem to be phased at all. And if we look at those minutes, what could we see inside the minutes? I think it's going to be sort of a way to peel back the onion a few layers and look and see where do they see growth and inflation expectations really? What were the discussions about? We've already saw through the PCE data that we've attained the Fed's 2% inflation. It doesn't mean we're above it. It doesn't mean we're starting to explode. It means we've kind of hit their level when they feel comfortable. The growth levels have been kind of volatile. We saw lower growth earlier this year that rebounded. Then we saw the GDP now numbers come in very high, but they've been trending a little bit lower. So where is that GDP growth versus inflation going to culminate? How can the Fed raise rates or continue to talk hawkishly if growth isn't north of 3.5%? Likewise, if inflation numbers don't hold, if oil prices start to come off and inflation doesn't hold, how can they continue to be so hawkish? So right now, the Fed really wants to raise rates twice more this year, once in September, once in December. They're going to need stronger inflation numbers and higher growth numbers to do so. And if you look at the back end of the yield curve, yields are continuing to drop. So they are not buying whatever the scenario is they're painting about higher inflation. They're not buying higher growth. The bond market's not buying it, or at least they're not buying it today. So right now, the Fed may have some explaining to do. We could find out another piece of that puzzle on Thursday, followed by Friday's jobs report. This is Todd Colvin coming to you from the floor of the CME Group.